To maximize profits while minimizing risks in trading, it's essential to have a deep understanding of proven strategies. In this discussion, we'll explore 3 effective approaches: trend following, risk management, and scalping. Trading is a journey that involves ongoing learning and adaptation. It's not about quick riches, but rather about developing a reliable methodology that can withstand market changes. Consistent profitability requires not only knowledge of these strategies, but also diligent application. The path to profitable trading is built on knowledge, discipline, and adaptability. Let's start by examining the concept of trend following. Trend following. Trend following is a strategy focused on recognizing and capitalizing on the dominant direction of asset prices. Traders often say, "The trend is your friend," emphasizing the value of aligning with sustained market movements. To identify trends, traders rely on technical analysis tools such as moving averages and trend lines. For example, an uptrend can be identified by observing a pattern of higher highs and higher lows. Once a trend is spotted, traders look for entry points that align with its direction. Trend following requires patience and a clear exit strategy to secure gains and reduce losses. Risk management. Call. Risk management is a fundamental component of successful trading. It entails taking steps to protect your capital from substantial losses. Effective risk management ensures that you can stay active in the market long enough to reach profitable trades. One essential aspect is determining an appropriate position size for each trade, never risking more than you can afford to lose on a single trade. A common guideline is to risk only a small percentage of your capital, typically between 1% and 2% on any given trade. Another critical tool is the stop-loss order, which automatically closes a trade at a predetermined price level, limiting potential losses. Stop-loss orders are invaluable for managing risk and protecting your capital from unexpected market movements. Scalping. Scalping is a high-frequency trading strategy where traders aim to profit from small price changes over brief periods. Scalpers focus on exploiting minor price discrepancies and taking advantage of rapid market movements. This strategy requires a thorough understanding of order flow, market depth, and the ability to make quick decisions. Scalpers typically operate on very short time frames, using charts with intervals as brief as 1 or 5 minutes. They rely heavily on technical indicators that highlight short-term price fluctuations. Scalping demands discipline, intense focus, and a high tolerance for risk. Successful scalpers follow a detailed trading plan, have strict risk management rules, and possess the ability to remain calm and make swift moves. Summary. In this discussion, we've explored 3 distinct trading strategies: trend following, risk management, and scalping. Each offers a unique approach to navigating the markets, and the most suitable strategy will depend on your individual trading style. Trend following aims to capture significant price movements by riding established trends. Risk management is focused on protecting capital and ensuring long-term market participation. Scalping seeks to capitalize on minor price changes over short time frames. Regardless of the strategy you choose, discipline and patience are essential. To further develop your trading skills, backtest your strategies, start with small trades, and commit to continuous learning. By mastering these strategies, fostering discipline and patience, and continually seeking knowledge, you can enhance your success in the dynamic world of trading.